Hey everyone, it's Rich Warner from the Smart Investor Models YouTube channel. Glad you could be with me again today. This is a follow-up video to the video that I recently made about tax loss harvesting. If you haven't seen that video, it's a good introduction to the subject of how short-term active traders and long-term passive investors can harness the power of tax loss harvesting, TLH for short, to offset future capital gains in taxable brokerage accounts. In this video, we're going to explore 4 case studies, 4 scenarios of how to use tax loss harvesting strategies. So in this hypothetical example, we have Sarah, who is a long-term passive investor. She holds a $50,000 position in SPY, and she notices upon review of her recent brokerage statement, or she goes online, logs into her brokerage account, and she notices on the online trading website that her position, which was worth $50,000 just last week, is now down to $42,000, a paper loss of $8,000. So what she should immediately do is, if she believes that the market has pretty much bottomed out, is sell the position in SPY in this example and replace it with something else that is going to act as a proxy replacement, if you will, for a SPY. She does her research and finds a list of proxy ETFs that she could replace that losing position in SPY with. She could also consult the Wash Sale Guard app, which I talked about in the previous video, which is an app that I designed. And by the way, there's a link for that app below in the description box, which will actually suggest some of these proxy names or tickers that she can use to replace her position in SPY. So she realizes, let's call it a long-term capital loss in SPY, and then she finds VTI, the Vanguard Total Market Index ETF, which is highly correlated to SPY, but she could have used SPY-G. If she wanted a growth version of SPY, she could have used SPY-V. If she's worried about volatility, she could have used SPLV. What she doesn't want to do in this example is to replace SPY with something very similar to it. And so there are only a few that come to mind, but it would be ETFs like VOO, VOO, IVV, or SPYM as an example. She could consider going with diamonds if she wanted to replace SPY with the Dow Jones Industrial 30 Index. She could even use a leveraged form of SPY, call it U-Pro, for example, which is a 3 times levered instrument. I wouldn't recommend that necessarily as my first replacement for her, but she could do that. It would work and would be permitted by the IRS. And to recap a point made in the previous video, the reason we're using a proxy to get back in is so that we do not violate the 61-day wash sale rule window period. And essentially, you really have to start counting from the day that you exited SPY in this example, and you cannot get back into SPY or a SPY equivalent within 30 days. But she can use one of the suggested proxies that we mentioned instead of SPY and get back in right away if she wanted to. This will help her avoid the wash sale rule violation, or disallowal, if you will. So what happens to the $8,000 that Sarah realized as a loss? Well, that can be used to offset capital gains in real estate or in other investments whenever she realizes a gain in them in the future. So the $8,000 is really adding to her tax bank of cumulative losses that she's realized in the past. And it's that aggregate, that sum of carry forward, the tax bank, if you will, that can be used to offset future capital gains, whether in real estate, collectibles, or in anything, including financial securities, as long as they're in taxable brokerage accounts. Now, since Sarah happens to be a long-term passive investor, chances are she's not going to be doing any market timing. So she's going to want to realize the loss in SPY and immediately get into the proxy ETF. That may not be your particular situation, but it is in many cases when it comes to long-term passive investors. So the key takeaway here from this case study, the first example, is that you don't have to sit on the sidelines to get your tax break. In our next example, we have an investor named Mark. Let's say tech stocks have done very well in the past year. And let's say, for example's sake, that Mark has netted a $20,000 gain from a tech investment. Let's call it IWI, the supercharged large cap growth ETF. He would be facing a tax bill of $7,000 on this short-term capital gain because he happens to be in a high tax bracket. And remember that short-term capital gains are taxed as ordinary income. But in contrast to IWI's exceptional performance, he's got a biotech ETF, let's say XBI, and it happens to be down on the year, and the paper loss is currently negative $15,000. So let's say Mark wants to take his profits in IWI and shift it to something a little bit more conservative, let's say something like DGRO, but he still believes in the biotech index as an investment opportunity. So what Mark can do to help reduce his short-term capital gain tax of $7,000 on IWI is to exit IWI and perhaps replace it immediately with DGRO, a little bit more conservative style of investing there. But then as far as XBI is concerned, he has a paper loss of $15,000. Why doesn't he realize a short-term capital loss in XBI and replace it with something like IBB? Because even though it's a biotech ETF, it has a different factor approach, investment style. It's not exactly the same approach as XBI. And so he could use IBB, or another one that comes to mind is FBT, which is the ARCA Biotech Fund. He can use either one of those as proxies. And so by realizing the loss from XBI, he's offsetting the $20,000 gain from IWI, reducing his net gain to $5,000 essentially, and being taxed only on that. And so instead of having to pay a tax bill of $7,000, his new tax bill drops to $1,750. That's a savings of $5,250. This example also shows us that harvesting short-term capital gains for active traders is among the most profitable uses of tax loss harvesting. In example 3, we're dealing with a high net worth individual, a high income earner. Let's say this guy's name is Jim. And Jim earns an enormous amount of money every year. He earns $300,000, but he's had his share of bad investments along the way. Let's say he made a bad investment in Bitcoin or some crypto asset, and he's suffered a $30,000 loss. So in this example, let's say he had no net capital gains that year, but he has this $30,000 loss on paper from a crypto investment. Well, he can harvest the losing position in that crypto asset, so he takes a $30,000 loss. Since he has no net long-term capital gains that year, he can use $3,000 of that $30,000 loss to offset his $300,000 income. Doesn't sound like much as a percentage, but hey, every little bit helps, especially if you're in a 37% tax bracket. So you subtract $3,000 from his $300,000 income, and he's only taxed on $297,000. It ends up being a savings of about $1,110 in tax liability. But the good news is that $27,000 can be carried forward into future years when he may have capital gains from other investments. So the moral of this story is that TLH can help provide a tax refund on your ordinary income, not just on your investments. And those $27,000, $30,000 minus the $3,000 he was able to take to offset his ordinary income, $27,000 carries forward into the future. Okay, in our final example, example 4, we have a long-term wealth builder named Emily. And this is an example of how you can use tax loss harvesting to offset gains from non-financial investments. Now, Emily suffered pretty heavily during the 2022 bear market. She lost on both her bond positions and on her stock positions. And she didn't violate any wash sale rules, so she was able to carry those losses forward. Now, Emily is a real estate investor, and she has multiple rental income properties. She sells one of those properties for an $18,000 capital gain. So she's got $18,000 in capital gains from her real estate investments. She's got this $25,000 tax bank that she can carry forward into the future. And it's 2026 now. And so what Emily's going to do is to use $18,000 from that tax bank of $25,000 to completely offset the $18,000 gain from her real estate property. So assuming there are no other capital gains to consider, in Emily's example, she will pay 0 capital gains that year. And Emily still has $7,000 of unused tax bank carry forward money that she can use for future investment gains. The key takeaway in this example is that tax loss harvesting can provide tax relief for physical investments like real estate as well, not just your financial investment. And of course, this can apply to collectibles such as art, stamp collections, sports memorabilia, what have you. Now, I'd like to wrap up this video by reviewing some common pitfalls and also share some professional tips for you when it comes to tax loss harvesting. First point is that tax loss harvesting is great for harvesting losing position. The point is that you should never let the tax tail wag the dog. Your investment strategy should always come first. If you have a winning position, you should not feel obligated or pressured into taking profits too soon. That's number one. The investment strategy always comes first, not the tax rule. In many instances, the investment strategy, the offense, always comes before playing defense using tax loss harvesting strategies. In other words, don't just sell a great investment so that you can save money in paying taxes. You should hold on to great investments for the long haul if you can. Key point number 2, remember that tax loss harvesting only applies to taxable brokerage accounts. It does not apply to qualified accounts. So you do not have to worry about taking losses and wash sale rules in a qualified account, in a Roth IRA or 401k, SEP IRA type of thing. You can realize gains in a Roth IRA, take realized losses in a Roth IRA all day long till the cows come home. And those tickers and securities do not affect what you do in your taxable accounts. Having said that, you should be mindful that when you take losses in a taxable account, buying it back in a qualified account before the wash sale window period is over can wipe out or disallow any capital losses that you've taken in your taxable account. So it really matters where you've realized the loss. If you've realized the loss in a taxable account, be careful that you do not buy it back within the 30-day window, even in a qualified account. The reverse is not true. So you could realize losses, like I said, all day long till the cows come home in qualified retirement accounts like Roth IRAs, 401ks, and then you can buy back that security in a taxable brokerage account. That's okay, but not the other way around. Finally, tax loss harvesting may not be the best option for you, even as a long-term passive investor, if you plan to leave assets to heirs. And that's because of the step-up basis rule upon the death of an account holder. When it comes to estate planning strategies, particularly, tax loss harvesting strategies may not be optimal. But this is an advanced estate planning concept. It's not my area of expertise. I just wanted you to be aware of this. So in summary, tax loss harvesting, TLH, turns market volatility into a strategic advantage. If you'd like to find out more about bucket investment strategies, you should check out my recent book called The Smart Investor's Guide to Bucket Investing by Richard Warner, and it's available on Amazon. I'll provide the link below this video. And you can also check out my new app that I designed expressly for tax loss harvesting. It is the Wash Sale Guard app, and it's available on the smartinvestmentmodels.com website. And I'm going to post a link for it as well below this video in the description box. Now keep in mind, I'm going to be also producing a video about how to use the Wash Sale Guard app and also the date calendar function. It's very useful. I use it personally for my taxable brokerage accounts. It automatically archives those trades into a tax bank spreadsheet for you. So it's quite useful and it's reasonably priced. I hope you check it out. Thanks so much for watching. This is Rich Warner again for the Smart Investor Models YouTube channel, and I'll see you in the next video.